Good morning, everyone. I'm Alex Repko with Whittier Trust Philanthropic Services, and I want to welcome you to this morning's webinar on creative uses of donor-advised funds and proposed tax law changes. Before I turn it over to our speakers, a couple of housekeeping matters. We will be saving time at the end for a Q&A, but we'll also pause briefly between sections to answer a few questions as they come in. Please feel free to use the chat in the upper right-hand corner, and I'll be monitoring them throughout the presentation. Pegine, over to you.
Great, thanks, Alex. Well, good morning, everyone. I'm delighted to be here and spending this hour with you talking about one of my favorite topics, donor-advised funds. You'll find full speaker bios at the end of this slide deck, which we will be circulating after the webinar is over. But just a couple of high-level points about myself. I'm a senior vice president with Whittier Trust's Philanthropic Services. Whittier Trust is a privately held wealth management firm serving ultra-high net worth clients. And as a philanthropic advisor, I manage a portfolio of private foundations and donor-advised funds and a few nonprofit endowments, essentially providing full back office support for them, philanthropic advisement, help in meaningfully involving the next generation of clients and their philanthropy. I'm delighted to be joined today by Rajpal Gibson of GHJ Advisors, and I'll turn it over to you, Rajpal, to say a couple of words about yourself.
Thank you, Pegine. Good morning, everyone. Thank you for joining us. It's a pleasure to be here this morning. My name is Rajpal Gibson, and I am a senior tax manager at GHJ Advisors, and I'm the high net worth practice leader here at the firm. We're a full-service accounting firm, and my division works exclusively with high net individuals, their families, and their family offices to create creative tax solutions, including charitable giving, which we're talking about today. Thank you to Pegine and Whittier Trust for inviting me to speak with you today. That you guys have been wonderful partners, and we really enjoy working with all of your clients as well.
Yeah, I'll just chime in and say I agree. We share a lot of clients with GHJ Advisors, and they've been wonderful thought partners, so we're grateful for that. Okay, well, let's just jump in. Today's presentation will be essentially in 3 sections, and as Alex mentioned, we'll try to pause after each section and see if there are questions. The first one we'll focus on is just providing an overview of donor-advised funds. I want to make sure that we have a kind of a level playing field to begin. Some of you may have them, some of you may not know anything about them, so we'll just give a little background. The second section is creative uses of DAF, some of the trends that we are seeing as people kind of wake up to the beauty of donor-advised funds and see how they can provide good solutions for their challenges. And then finally, we'll finish with a summary of some of the proposed tax law changes, which, if they come to pass in the next several months, will make some changes to what we're about to say. So, okay, what is a donor-advised fund? Unlike a private foundation, which is a separately incorporated, tax-exempt entity, a donor-advised fund is a charitable vehicle, but it's really just an account. It's a fund that's held at a gigantic, public charity called a sponsoring organization. And donors into these funds retain advisory privileges. They get to advise or recommend on grants to be made from their donor-advised fund accounts. So donors contribute funds into their DAFs, and they receive an immediate income tax deduction for the fair market value of what they've contributed. Technically, they've given up control. Once you make a grant to a DAF, the funds are no longer yours. They belong to the sponsoring organization. But as a practical matter, that sponsoring organization is going to heed the wishes of its donors. If it doesn't, it'll find itself out of business pretty quickly. So the only grants that typically are not processed as requested by donors are those that are going to support terrorist organizations or ones that aren't qualified charities. One interesting difference about a DAF is that there's no required annual payout, at least for now. And Rajpal will get into that a little bit later. But for now, unlike a private foundation, which requires 5% of its assets to go out in the form of grants every year, DAFs don't have that. And the other interesting thing is they can be called whatever you want them to be called. The IRS does not care. You can call it the Smith Family Fund. If you prefer the term foundation, you can call it the Jones Family Foundation. It makes no difference. There's a lot of flexibility there. So this is just a chart for those of you who are visual learners. I'm not going to walk you through it, but it's essentially, what I said about the contributions going in, the tax deduction going back, and then grants coming out. So what makes a DAF such an elegant vehicle? First of all, it allows for the greatest tax deductions. So foundations, for many of the assets that go into it, you're only going to be deductible at cost basis. But if you're going to be, contributing highly appreciated alternative assets or even stock into a donor advised fund, the deduction will come at fair market value, which is, a real benefit. It's a great way to diversify out of a highly appreciated asset. So if you've got a stock that you bought for a low basis and now it's quadrupled in value, you put it into the DAF, you get your fair market value deduction, and then when the assets are sold inside the DAF, no capital gain is realized. So it's terrific. It's also a great way to do what we call a charitable swap. So if you love a stock, it's done really well for you and you like to hold on to it, but you're never going to want to sell it because you'll get killed on the capital gain. Put it into the DAF again, sell it there, and then you have all of those funds available for gifting. You can turn around and use other private assets to repurchase that stock that you love in your personal accounts. So DAFs in theory can be perpetual. They aren't always. We'll talk a little bit more about that later, about the differences between some DAF platforms. But in theory, they can last forever. They can be a wonderful vehicle for generations to come in your family to make gifts. The other thing that I think is meaningful to a lot of our clients is that donations coming out of a DAF can be anonymous. That's very different because private foundations are not true. Their Form 990 PFs are available, a matter of public record, but if you wanted to make gifts anonymously through your donor advised fund, it's very simple to do. And then finally, this trend about private foundations opening sidecar DAFs. I'm going to get into that in a lot more detail a little bit later.
Pegine, before we move on, I really want to point out that I think that asset swap concept that you talked about is really meaningful, and you don't hear a lot about it. It's really interesting if you think about all the work that goes into making sure that a portfolio is properly diversified and that the allocations are correct. If a donor decides that they want to make a donation into a DAF, sometimes they have to reallocate, figure out what else to do, maybe sell some assets and cause capital gains. It's a really nice way to say, okay, I've got money that I was going to gift anyways. I'm going to instead contribute appreciated stock into the DAF, and now I can use the cash to swap out, which I think is fantastic, swap out into the same stocks with a higher basis. And so it's as you mentioned, it's a very elegant way of doing creating that solution.
Thanks, Rajpal. So I'm just going to go through this briefly, but I mentioned that they're not all donor advised fund platforms are not equal. I would caution you to read the fine print in the establishment documents and decide what's important for you. What exactly are you trying to accomplish? Community foundations are, a really good source for donor advised funds, and they're perfect for people who really want their DAF platform to have a lot of depth and breadth of knowledge in their local community. Many of them, though, because they have their own charitable mission, they are understandably trying to get funds into their general fund so that they can support the community, have provisions that say, you can name one generation of successor advisors, but not more than that. The funds will then roll over into our general fund. Or, you can sorry, you can only, when they quote their fee, they might say to you, well, we'll charge you 80 basis points to run this foundation, this DAF. But really, they're not including the additional cost for investment management. So you need to ask them what all is included in the quoted fee. Sometimes you have some choice or influence over investments, often not. The other choice that you have, or another choice, are the larger institutional DAFs, like Schwab, Fidelity, Vanguard. For people who are very fee conscious, they tend to have lower fees, so that might be attractive. You might have, a really robust online platform. So if you like to just kind of get on your phone and direct a grant, it could be a really good choice. But if you're looking for something that's higher touch, a dedicated advisor who can really work with you and your family across generations, it's not going to be the right choice probably. So I'm just going to say a quick couple of words about Whittier's, just to let you know, kind of orient you to ours. We created this DAF platform in direct response to what our clients were coming to us and saying they wanted. They were frustrated with a lack of flexibility. They didn't know why their DAF platform wouldn't accept appreciated real estate or private equity. So we are comfortable with those kinds of alternatives, and we do it all the time. And we don't have any limits. Since we don't have a general fund or a separate mission, we have no limits on successor advisors. So we're happy to work with your family across generations, which is really what we do. One more slide before I turn over to Rajpal. I like this one because I feel like I want to debunk a common myth that is out there. When we get to talking about what the proposed tax law changes are, I like to say that it's a solution in search of a problem. You hear so often that DAFs are where charitable dollars go to wait, that people can put the funds in and there's no payout requirement, therefore they sit there forever. And that is just not true. The data does not bear out that myth. So look at this chart, and somehow I apologize, the source fell off of this chart, but it's the National Philanthropic Trust's 2020 Donor Advised Fund Report. And if you look at it, different kinds of sponsoring organizations, but for the years 2017 through 2019, payout rate is hovering at over 20%. So, private foundations are giving away about 5%. DAFs are giving away significantly more. Rajpal, I'll turn it over to you.
Thank you, Pegine. With this chart, we wanted to provide a side-by-side comparison of private foundations and DAFs. There's a lot of information here, and in the interest of time, we thought it made more sense for everyone to go through the detail on their own. We're going to be sending out the slides after the presentation. So if we could advance to the next slide, what it boils down to is this slide is the to DAF or not to DAF. And generally speaking, as Pegine has said, DAFs have a lower barrier of entry compared to private foundations. They're easier to set up. They have lower startup costs, less administrative burdens. There currently is no payout requirement. They allow for greater confidentiality and a potential for higher tax deductibility based on the donor's AGI. Likewise, there's no tax return and currently no excise tax on earnings. And so those are the benefits of a DAF. And on the other hand, the benefits of a private foundation would be that they allow for greater control. They do allow for greater investment management decisions and collaboration there. They oftentimes are seen as allowing for greater variety of assets to be donated into it. And one of the things that's generally quite important to somebody who sets up a private foundation is they are able to employ and compensate family members who are interested in continuing forward with the foundation and working for the foundation, something that a DAF doesn't allow. So it really depends on what your family and what your interests are and where you put the value.
I want to go back just for a moment to this slide and just point out for everyone, you'll see right about the middle of the donor advised fund column that the deductibility limits are 60% of AGI for funds going into a DAF, if you're contributing cash. That was true pre-pandemic. The CARES Act, and we'll talk a little bit more about that, has raised that AGI limit for last year and this year. So I just wanted to make sure that nobody gets confused about that.
So we're just going to pause here for questions, because we have a lot of good questions coming in. So thank you for submitting those. One good one we have that an audience member is asking is, can you move funds from a community foundation DAF to the Whittier DAF platform?
Yes, absolutely. That's one of the beautiful things about a donor advised fund, is it's very easy to move the funds. Essentially, all you do is open up a new DAF at the platform that you're looking to go to, and then you make a grant from your old DAF for the full amount of the funds in that fund over to the new one. It's as simple as that.
Great.
Do you want to ask one more, Alex?
Yes.
Before we move on?
Yeah, perfect. Another one we have is there a limit on how much money you can put into a DAF each year?
There is not. There is not.
Yeah.
I think an elegant solution, because there's no minimum. I mean, some of the sponsoring organizations will set their own minimums, but there's no legal minimum. Unlike a foundation, you wouldn't want to open a private foundation with 50,000, but you can open a DAF with something that small, and there's no upper limit.
One of the strategies that we normally do, that we employ, one of the thought processes that we normally employ in determining how much to contribute to a DAF is taking into account the expected AGI of the donor. And charitable contributions actually allow for a 5-year carry forward for any unused contributions. So we would like to keep it within that range so that none of those contributed dollars are lost.
Yeah, good point. Okay, well, let's jump into the next section, which is what are we seeing? How are people using DAFs? This is a pretty dense slide, and I apologize, but there's a lot going on here. What we're seeing at Whittier is that a lot of our clients who already have private foundations are saying, why don't we have a DAF alongside? Because it'll help us solve whatever challenge we're facing. So the first is the stress of the 5% payout. We've mentioned that a foundation has to essentially gift out 5% in qualified distributions. Some foundations don't have trouble at all meeting that. In fact, they're always, kind of having to ratchet back their giving so as not to deplete the corpus. But there are some, depending on how they structure their giving, that really sweat that out every year. They struggle. And at the end of the year, they're thinking, oh my God, are we going to be able to make our 5% payout? If you have a DAF on the side, you just kind of come whatever your trigger date is, move the rest of the funds that constitute your 5% over into the DAF, and you're done. And then those can be gifted out, calmly and on whatever time frame you want. Another one, and we're seeing more of this because we are living in such a time of political polarization. We're seeing foundations run by family branches that have very different political views or values, and they find themselves at odds. They're just, family foundation meetings are devolving into, times of misery. And I had one that called me a couple of years ago that they weren't actually a client, but they just said they needed help trying to get through this challenge. And they were at the point where they were going to have to just split the foundation in half. It was just, meetings were miserable. And so ultimately we ended up proposing a donor advised fund, and they just, put the funds into the DAF. It doesn't have to have the family name associated with it. No one else gets to decide how you direct your director grants. And that allows the family to just stick to the mission of the foundation, which everyone can agree on, and, have a happier time. So they're no longer at war. Another one is tipping. I don't know if you've heard of the concept of tipping, but public charities are required by the IRS to essentially show every year that 33% of their revenue comes from public sources. For now, at least, donor advised funds fall into a loophole where any contributions coming from a DAF are considered public support and not private. So it's a really nice way if you are a donor that has a favorite charity, maybe one you even started yourself, and you want to keep funding it, but You don't want to tip it and jeopardize its public support status, its tax exemption status. Just have the funds come in, in dribs and drabs through the donor advised fund. It's also a good way for younger folks to get their sea legs as they're beginning to become involved in the family philanthropy. Have a donor advised fund and let some of the younger family members make their grants out of that while they're learning before they step onto the foundation board. We've already talked about tax exemption. It's a fantastic alternative for alternative assets. So I have one client who a couple of years ago, they have a long-standing family foundation, functions just fine. But she had a highly appreciated condo that she was just tired of maintaining, wasn't using. She said, "Can I put it in the foundation?" I said, "Well, you can, but you don't want to. You need to put that into something like a DAF instead." And so that's what she did. She has a sidecar DAF, the condo in there, sold it out of the DAF, and was able to take advantage of the full fair market value reduction. And then finally, we're seeing something that I didn't see coming. A lot of larger foundations that are wanting to do collaborative grant making are finding that if they pool their funds into a donor advised fund that will function as a pooled fund, they can attract new donors and also not be bothered with the headache of doing all the sub-granting that comes out of that fund. Mm-hmm. We handle that. And then they just get to kind of advise on where the grants go. So it's working out very well.
So now we'll move on to using a CRT, which is a charitable remainder trust, alongside a DAF. And I'm actually going to ask that we move to the next slide. There's really a nice illustration here on this page so that you can see, again, for the visual learners, and I happen to be one, to see what the transaction looks like. So as you can see here, a donor contributes an asset, and in this case, we have a gift of stock, to an irrevocable trust. So an irrevocable trust, it's important that you recognize that the asset is no longer owned by the donor. But that also means that it's no longer in the donor's estate. So this is a great estate planning tool. The value of the asset is then bifurcated into the income portion and into a remainder interest. And the actuaries and appraisers will help bifurcate that asset. And so the donor takes an immediate tax deduction for the portion of the remainder interest, so the fair market value of the remainder interest. And when appropriate, the trustee of the CRT can sell the trust. Now, it's interesting because the CRT is a tax-exempt vehicle. And so if there's highly appreciated asset that's being transferred into a CRT, nobody pays the capital gains there. That's really wonderful. It's tax-free. And then the proceeds can be used to pay the income stream to the donor, to reinvest into other investments, and then eventually pass out to charities or to a DAF, and we'll get to that. Or if the income stream from this asset is sufficient to pay the donor the annuity that they're supposed to be getting, you don't actually have to sell the asset. You can just maintain the asset until it's time to pass it out to a DAF. Now, it's a really nice structure that allows the donor to sort of turn off and turn on the spigot of donations out to charities as they choose to. There are some costs associated, so hiring an attorney to draft the trust documents and an advisor to a number of advisors. Maybe it's your tax advisor, it's your estate planning attorney, maybe it's Whittier Trust, to come together and see if it makes sense for the family. Now, ordinarily with the CRT, you would name who you wanted the remainder charity to be. Say you decide that you really want to support your alma mater or your children's school, and you name that in the trust. Well, instead, what some people are doing is, instead of naming a charity in the CRT, they're actually naming their DAFs. And what does that allow? It allows a lot of flexibility because, as you know, as life evolves, we become more and more interested in different types of charity work. It may not just be your alma mater. It may not just be your child's, education institution. It may be that you become more interested in sustainability or climate change organizations. It may be that somebody in your family is impacted by cancer, and you might have an interest in supporting those kinds of organizations. If you were to have named a charity in your CRT, and you wanted to change that charity and that remainder interest, you would actually have to go to an attorney, have them redraft the trust document, and there's a cost associated with that. Instead, if the DAF had been set up as the remainder interest, then you just go to the sponsoring organization, no cost to you, let them know that you'd like to now contribute to these new charities that are near and dear to your heart. So it's a really nice quick fix, and it allows for a lot more flexibility. So as you can see, CRTs are used in a variety of reasons, for estate planning tools, for income tax tools, to help maintain a little bit more control, and all of the wonderful things that DAFs offer, like involving future generations. So and we really think it's a very creative, a lovely tool when you use them together.
I want to say one point of clarification. When we say a CRT is a tax-exempt organization or entity, it doesn't mean that you can completely escape the capital gain. What we say is the capital gain is deferred because the income stream that comes out of a CRT to those income beneficiaries is taxed, and some of that will be on the capital gain.
That's right, Pegine. Thank you.
So there's kind of two buckets of reasons why pairing your CRT with a DAF instead of a designated charity makes sense. The first bucket is, what's the benefit to clients of doing that, to the donors themselves? The second one we'll talk about is what's the benefit to the charities that you want to support. So for clients, as Rajpal said, it gives you more flexibility and more control. If things change over the course of the life of the CRT, let's say that suddenly the charity that you thought was so fantastic is not so much anymore. There was embezzlement there, or the visionary leader has left and it's gone downhill. Often these kinds of things are kind of set it and forget it. Yes, you can go back and change it by hiring an attorney to change the designated charity, but it's so much simpler. You won't have to do that if your designated charity is your own DAF. Right? And also it's a nice way to involve future generations. It's like, if you just name as the beneficiary of your CRT your alma mater, then when that trust dies or ends, terminates, those funds are paid out and it's over. If you name a DAF, it's kind of like giving a philanthropic gift to future generations because they can continue to use the fund. So what's in it for the charities? You might say, wait a minute, wouldn't it be better for them to be named as the entity and get all the money? And I would argue often not very much, especially if they're smaller. You just don't know how getting a giant infusion of funds, $1, $2, $3, $10 million will land on a particular charity. Sometimes it overwhelms them. Sometimes, if there's the risk of litigation, which in this country, there's always the risk of litigation, then those funds, if the charity owns them, they're available to creditors and can be accessed, right? If it's coming from a DAF in the form of annual grants, they can't be accessed because the charity doesn't own them yet. And finally, if you really love this organization or these organizations and you want to benefit them and help them, bring in more funds, can treat each of the annual contributions from the donor advised funds as a challenge grant to help them kind of increase and diversify their funding sources over time. Okay, I'm not going to say much about this. What I will say about contributing S Corp shares is it's tricky. A lot of clients are coming to us saying, I've got these S Corp shares, I'd like to offload them, I'd like to turn them into something philanthropic, how do I do it? And the truth is, it's challenging, right? On the one hand, it's better to contribute those types of assets to a DAF than to, for example, a CRT. CRT is not an eligible qualified shareholder. So you contribute them to a CRT and it'll just defeat the S Corp election. On the other hand, you're going to pay taxes anyway. If you just dump S Corp shares into a DAF, you're going to end up paying UBIT. Capital gain still has to be paid. So we started asking ourselves, is there nothing? Is there no way to do this? Turns out there is. And on the next 3 pages of slides, which I will not walk you through, there are some creative solutions that we've come up with in conjunction with some of the more sophisticated attorneys in town. So just know, if these are here, you'll have access to the slide deck later. And if S Corp shares is something relevant for you, give us a call and we can talk about it.
Absolutely. That's a great way to end that, because they're so specific and require the right fact pattern in order to work. It's better to just reach out if you have any questions.
Great, thank you. So we still have some really good questions coming in. One of them is, does Whittier have an internal policy that gifts have to be made from a DAF within a certain time frame?
We do not. We have no such policy. We don't have any limits on successor advisors. We don't have any payout requirements or any requirement about activity level. I will say, as a practical matter, most of our clients who have donor advised funds are active. They use them to make gifts, but it is entirely up to them.
Great, thank you. And we have one more. Can an IRA owner who can take advantage of making a charitable distribution of $100K of their required minimum distribution to charity make that donation to their DAF?
You want to take that, Rajpal?
Yeah, I have not seen it, but I don't see, I'm not sure that there would be a problem with that, because
I actually think that they are excluded from it. I do. I think it needs to go to a charity. Every now and then you see tax provisions where it sounds like a DAF should qualify because technically it's at a public charity, but there are exclusions, and I believe that donor advised funds are not eligible for that particular contribution.
Yeah, no, I haven't seen that, so that would make sense.
Great, thank you.
Is there another one, Alex?
Yes. This is more general. Can you move funds from a DAF to a family foundation?
Yes. So it's much easier to, no, I'm sorry, strike that, reverse it. It is much easier for a foundation to make grants to a DAF, because of course DAFs are qualified charities. For a DAF to contribute to a foundation, you're going to find some sponsoring organizations that will say, no, you just can't do it. Some will say, yes, you can, but you have to exercise expenditure responsibility, because private foundations are not qualified charities. So it's really going to depend on your sponsoring, sponsoring organization. But I think if that's your intent, if you think you know that you're going to want to make contributions from a DAF to a foundation, it might not be the right vehicle for you. Do you have anything else that you would add, Rajpal?
No, I think that's right on.
Well, thanks, Alex. Let's jump right into the proposed tax law changes.
All right, here it goes. So Senator King and Grassley proposed the ACE Act. ACE stands for Accelerating Charitable Efforts. So their desire was, as Pegine mentioned in a previous slide, they really feel that charities that the DAFs are holding funds and not distributing them out, which is not does not follow the facts. But June 9th of 2021, they proposed this new legislation, and essentially it's creating 3 new types of DAFs. The first new type of DAF, if you want to accelerate to the next slide, is effectively a 15-year DAF. The way that they're achieving this is that you have to set up a written agreement with the donor, has to set up a written agreement with the sponsoring organization, and it must be signed and the stipulations of the agreement is that after 15 years, all of the contributed funds and the earnings from the contributed funds essentially need to be granted out to public charities or to charities outside of the DAF. Otherwise, in my opinion, it's punitive excise taxes that have to be paid by the sponsoring organization. And punitive in the sense that it's 50% excise tax. That sounds pretty punitive to me. A notable change is also in the tax deductions. So for cash and marketable securities, you still receive the same sort of deductions that you would currently, but for more complex and non-publicly traded assets, the charitable deduction would not be allowed until the sponsoring organization actually sells the contributed asset, and that's a huge change. And the amount would be limited to the gross proceeds that are gained from the sale of that asset and credited back to the DAF account. Very different from what what's allowed right now. The other add-on is that there's a requirement for contemporaneous written acknowledgments. That means that the sponsoring organization would need to provide the donor some documentation so that it could be attached to their tax return, as opposed to the donor going out and getting an appraisal. The design here is really they believe that some of the appraisals might be overvaluing the assets, and so it's a way and a design to undercut that and keep that from happening. So that is what a qualifying DAF is. The next type of DAF is a qualified community foundation DAF. And this is essentially location-driven charity. The DAF would need to be organized to serve a geographic community that's no larger than 4 states. Not sure how they determine that, but 4 states. And then the act would allow the donor to hold up to $1 million in DAF funds at a community foundation without being subject to payout rules. If the DAF has more than $1 million, then it's required to pay out a 5% payout annually. And again, this is also similar to the qualified DAF. It's effectively a 15-year DAF with the same sort of requirements on charitable deduction, same sort of tax deductibility, and the same sort of written acknowledgement rules, and the excise tax as well. So that is the qualified community foundation DAF. And now we move on to the non-qualified DAF. So this is everything else. The DAF the main pieces of this type of DAF is that no deduction is allowed until the property is sold and the sponsoring organization actually makes the distribution out to a charity, which is very different from what we are working with, what we have in place for DAFs now. And this type of non-qualified DAF is actually, it is essentially a 50-year DAF. And so those are significant changes. If we move to the next slide, we can talk a little bit about the changes to private foundations. So there's also some changes to private foundations in the ACE Act. Notably, salaries and compensation to family members will no longer be considered qualified distributions. Now, that doesn't mean that a foundation cannot make payments to family members. They're just not going to be qualified for the payout tests. And then the second piece of the act, the ACE Act, that affects foundations is this. It has to do with the public support test. So as Pegine mentioned, in order for a public charity to meet the public support test, it has to have 1/3 of its total support. Total revenue from the public. And so and if you recall, Pegine was talking about the tipping rule. So essentially, right now, a DAF is not considered part of the calculation for a 2% limitation. And what they're saying is essentially all forms of donation, whether it be from an individual, from their DAF, from grants, those are all going to be aggregated. So it's as if it's being treated as a donation from a single person. And what that ends up doing is it ends up tipping a person's contributions in their various avenues of donation and will disqualify them from the public support test. So basically, it's a complicated way of saying that it makes it harder for public charities to meet their public support test. And that's problematic.
And, what I would say about that is it has a logical appeal, right? You can understand it. That's why I called it a loophole before. It arguably is a fallacy that contributions from a donor's DAF should be counted as public support. They arguably sound more like contributions from this particular donor. It's just a different pot. So I think that's the logic behind it, but I think it will have a really deleterious impact on, the amount of support that some of these charities can get.
Yeah. And then the estate law changes. Most of you have already heard this. This isn't actually related to the ACE Act. This is something that President Biden campaigned on when he was being elected for president. This is, in our profession, this is sort of known as proposed changes that they anticipate. Nothing's been enacted yet. Essentially, an individual has $11.7 million, and a married couple combined have $23.4 million, and they can give this away in their lifetime or upon their passing. It's a combined pot. And if nothing is done by the Biden administration, and many people believe that something will be done next year, but if nothing is done, those rules sunset at the end of 2025, and the lifetime exemption will go down from $11.7 million to $5 million and adjusted for inflation. And what most people are anticipating is that the lifetime exemption is going to be brought down even further. Some people have put out the number 3 million. Some people have put out a straight $5 million. But essentially what it means is that the lifetime exemption is expected to decrease in the short term, maybe in the next year or two. And that can have that has encouraged a lot of people to start looking at their estate and decide whether they want to give to charity, whether they want to make some gifts, whether they want to employ some other tax strategies in order to save on the estate planning side. Washington State also has an estate tax exemption. It's at $2.1 million. And we wanted to use this opportunity to tell you that, there are obviously sophisticated ways that you can reduce your estate tax, but there are also very simple and unsophisticated ways, but are extremely effective. And that is to use the annual exclusion. Any individual can give another person up to $15,000 per year. So a married couple can give $30,000. A married couple to another married couple can give a combined $60,000. And that's a really great way to pass assets down year over year to other family members. And the really important thing to know is that this annual exclusion is not used to offset against your lifetime exemption. So it does not, if you gave away $15,000 a year to, let's say, all of your children and your grandchildren, that would not count against your lifetime exemption. Another way to reduce your estate, as we're talking about, and is very relevant to what we're talking about today, is to give to charity. And then the third way that we've listed here is called a super funding of a 529 plan. So a lot of people have heard of 529 plans. The distributions are used for higher education. And actually now they've changed the rules so that you can use it for other forms of education, lower grade school education. But if you use your 529 plan for that, there's no tax due with the distributions. And the really great thing that you can do is if you had a specific amount of funds and let's say a grandchild is born and you wanted to super fund a 529 plan, you could put 5 years of contributions, or $75,000 per donor, $150,000 for a married donor, and you can put that into a 529 plan in one fell swoop, and then you don't make future donations for the next 5 years. You don't make future contributions to that plan or gifts to that donee, but it really allows you to front load a 529 plan so it can start to grow. All the earnings out of a 529 plan are tax deferred. So you do not have to pay that and include that in your taxable income. So really great ways of reducing your estate if you wanted to.
Okay, before we turn it on over to the Q&A session, and we do want to leave plenty of time for that at the end, I just wanted to mention the CARES Act. I said earlier that the AGI limits have been temporarily increased, and that's what we're talking about here. So in an effort, post-pandemic to encourage charitable giving, recognizing that the country was hurting and that we needed to rely more on philanthropy, I think Congress raised the AGI limit for cash gifts to charity from 60% of AGI to 100%. That happened last year, and it was extended into this year. Now, this is one of those circumstances that we mentioned earlier, where donor-advised funds are excluded. You can give up to 100% of AGI, except not to a DAF. And so the question is, are you out of luck then? Not really, because there is a different kind of fund that functions very similarly to a DAF, but it's called a designated fund. And designated funds are not excluded from this particular law. So a designated fund operates the same way as a DAF, except that instead of having kind of an open-ended fund where you can recommend grants to any charities, at the time you establish a designated fund, you have to name a particular charity as a beneficiary. And if you do that, then you can have multiple funds, right? You could have 5 different funds that name 5 different designated charities. But if you do that, then the funds can be doled out over time, just as with a DAF. But the point is, you can contribute up to 100% of your AGI this year. And so I think indications are that it'll probably go away next year. So if this sounds like something that might be of interest to you, give us a call and we can talk through those possibilities too. And that's it. So we do want to open up for questions, and Alex can feed us some. But while we're doing that and having this kind of final conversation, if you would take a moment to plug an answer to this question into the chat, we sure would be grateful. So Alex,
Great.
What do you have for us?
Yes, we do a few questions. One of them, I believe, Pegine, you may have touched on this earlier, but it is, what happens to funds in a DAF when the donor dies?
So at the time that you establish a DAF, the establishing document will ask you, who are your advisors for the fund, and who would you like to name as successor advisors? And we advise our clients to please make sure you fill out that second section, because we never know what's going to happen, right? So at the moment in time that the original donor passes, let's say, man and wife were the donors and they were the advisors. Hopefully, in their establishing document, they name their children as successors, or their nieces and nephews, or whoever it is, so that it's a very simple matter. The advisory privileges just then kind of move over to the next generation.
Great. Another one we have is, can DAF advisors recommend grants to organizations without a U.S. tax exemption?
I'm happy to answer that. Do you want to take it, Rajpal?
Yeah, the answer is no. It's important that a DAF is designed to then move funds over to a tax-exempt organization or public charity. I am thinking of whether there are any exceptions for schools and others. There are some charities. Well, there are some organizations that are educational, but you would need to have a 501c3 receive those funds.
So Rajpal's right that, the general rule is, yes, you have to give to a qualified public charity, but there are exceptions. And once again, I think it depends on the flexibility of your individual sponsoring organization. Most, she's right. Most, I think, sponsoring organizations tend to play it safe and say, nope, we just won't do it. But our sponsoring organization is infinitely more flexible and has said that, yes, they're willing to process grants to non-qualified public charities if they exercise expenditure responsibility or seek an equivalency determination. So those are ways in which grant-making entities in this country can actually make grants to organizations that don't have a U.S. tax exemption. You just have to, kind of ask the sponsoring organization, I think, up front if that's your intention, because she's right, most will say no, I think, but we say yes.
Okay, great, thank you. We have a new one that just came in that is, can a DAF send funds to a 501c3 organization for care of a family member that has no funds?
So
I'm not sure how you would qualify an organization as a 501c3 if it's specifically for a family member. And therefore, usually that would be disallowed. I can't think of a situation where you would really be able to qualify an organization as an exempt organization that specifically is for a member of your family.
Yeah, or even to earmark the funds through a qualified charity to a member of your family. Self-dealing rules do apply, and they would prohibit that. There's some exceptions also if, let's say, you wanted to start a scholarship fund. There is a way, if you've check the boxes, dot your I's, cross your T's, you can open a scholarship fund, which allows you to make grants to individuals, but it's not going to be to your own family members. Then you have to follow certain rules to make sure that there is no self-dealing, because these are charitable funds.
Okay, we have another one. Thank you for that. This individual is still a little bit unclear about the proposed tax law changes, and they're just wanting you to hit the top 3 things they should keep an eye out for when it comes to their DAFs.
Well, so that's an interesting point. If you're talking about existing DAFs, the way that the language of the proposed act is written is this is for new DAFs. This is a act that is going to be effective January, if it passes, January 1st of 2022. So we don't have as much information on whether grandfathered DAFs would be impacted by the act. But let's say you're starting a new DAF in 2022. I would say that for qualified DAFs, it's important to know that essentially the advisory privileges that a donor would have expire after 15 years. You would want to distribute out all of the funds that are contributed to a DAF after 15 years. Otherwise, there are very large excise taxes. And then the third point would be that deductibility of the assets that are contributed to a DAF are different than they currently are stated to be. Essentially, your non-publicly traded complex assets would have some deferred deductibility. So that applies to the qualified DAF. For the community foundation DAF, it's a similar concept, except that you have limitations on the amount of money that can be contributed to that type of DAF, the limitation being $1 million unless you meet some certain payout rules, and that you want to limit the mission of that community foundation DAF to a specific geographic location that covers 4 states. And then for the unqualified DAF, it's a 50-year expiration date essentially, and the deductibility of the assets that are contributed into a non-qualified DAF are even further down the road until not only the assets are sold, but also that they are now granted and distributed out to a public charity. So hopefully that helps.
Okay, great. So a good question that can kind of sum up the Q&A session is, what is your prediction that this legislation will actually pass? Do you have any inkling or any feelings about that?
Boy, I'm not going to make a prediction. I'll let you make yours if you have one, Rajpal.
So it's interesting. This act is what's considered bipartisan. We have an independent senator and we have a Republican senator that are both proposing and endorsing the act. So that lends to potentially more of a chance to pass because you've got some bipartisanship there. But you know, this is the first act that has come up for public charities in nearly 50 years. Pegine, it's difficult to say whether it will pass. There's a lot of things that the administration already are looking to pass when it comes to tax law reform. Changes to the income tax rates, changes to the estate tax thresholds. So there's really a lot on the plate already. If I were a betting woman, I would probably say it may pass with, I don't think all aspects that have been put out there will pass. Maybe it will pass with some sort of adjustments, or maybe as a political trade-off, they will shift their focus towards income tax generation as opposed to changing the DAF rules.
Well, I hope you're right. But I think we're out of time. Thank you so much, everyone, for joining us. We want to be respectful of your time. We promised to get you out by 11 o'clock, and I think it's just a couple minutes to spare. So we appreciate your joining us. If you did plug in any responses into the chat, we're grateful for that as well. And you know where to reach us. You can find our contact information in our bios at the end of this slide deck. So,
thank you, everyone.
Thank you.